Hi, everyone, and thank you for joining us on this podcast. It's a special podcast because I have the pleasure to interview a dear friend, Mr. Neil Pinchuk, somebody that I've met and we became big fond of for the last 10 years, Neil. Probably more than 10 years we've been
Probably
friends. And
more,
yeah, and he helped me a lot throughout my life. And I'm very grateful that he made the time for us. Him and his partner are one of the most world-renowned firms in taxes. They are experts in international, a lot in Asia, but also locally. That's the most important thing. He is considered, Neil, as an expert in multi-state taxation, in partnership and corporate taxation, U.S. taxation of foreign companies, payroll, sales taxes, tax liability, and of kind of exchanges. Uh, he also is an expert in compliance with SEC and U.S. accounting and auditing standards and regulations. Expert witness. Also, he gives seminars and he is also a speaker in industry conferences about accounting. And he has been honored with the President Voluntary Action Award by the late President Ronald Reagan, one of the most important presidents of the land. He graduated with honors from the State University of New York and is licensed in the state of New York and other states as well. He is a member of the AICPA, NYSSCPA, and the NSA. So I couldn't have a better suited person to interview about. One is the OBB, which is the acronym for One Big Beautiful Bill that just passed, but also talk about matters that are important for dentists in regard to many other things. So, Neil, thank you so much for joining me. I hope from what I've said so far is correct.
yes. Yeah, that's a lot. Yeah, but it was correct. And thank you for having me.
Thank you, Neil. Thank you.
Yeah.
So we are discussing OBB. OBB is not really a new tax, but just so people know, it is the making it permanent for the tax legislation of 2017. And they added other things, and that's what we want to go over to see if there's an impact for us as a small business owners, dentists, or even patients, if they are looking for some healthcare benefits and stuff of that nature. So the law was supposed to expire December 31st, 2025. They finally passed the OBB. And since we talked about that, so let's talk about what happened in the 2017, because there is a tax reform that happened on the time of Obama. Then 2017, we had, in the first term of President Trump, we had that law, and now it's became permanent. So what had happened in the 2017?
In 2017, there were a multitude of changes, most of which benefited the taxpayers. They lowered tax rates, especially for corporations. They have a new flat rate of 21% now for corporations. They introduced certain provisions that help small business taxpayers. One of them is called the QBI, which is the Qualified Business Income Deduction. They introduced the PTET, and I'll go through all these more in depth in a few minutes. I'm just summarizing what they introduced. They introduced something called the excess business loss limitation. And they had lower rates for estate and gift taxation. So, well, actually, I should say they increased the exemptions for estate and gift tax exemptions. And all of these things were scheduled to be phased out over a number of years. And so this new bill, what it did was either made it permanent or just extended it for the next 4 or 5 years.
So not all of them are permanent.
Not all, most are, but not all. But when they say permanent, that's really not really permanent. It depends on the next administration and the
Yes,
next
yeah,
Congress.
yes, correct.
You know, they can pass laws to override all of this stuff. So it's by permanent, they mean that there's no scheduled expiration. Right.
Correct. Until a new president, if they win the Congress and Senate, can change them.
Exactly.
So uh, the importance of discussing these things because people underestimate the how big the influence of small businesses in the United States. And I send you a statistics for you to confirm it before I use it. The
Mhm.
Small Business Administration has defined that small businesses are 500 employees and lower. It constitutes a significant majority of all businesses in the United States. It accounts for 99.9% of all firms, which translate to approximately 33.2 million small businesses. Furthermore to that, small businesses play a crucial role in the economy, employing 46.4% of private sector workers and creating 62.7% of the net new jobs since 1995, meaning their role is crucial in the survival of any city or state. That's correct, right? So,
Yep.
having said that, any law that is passing, is it favorable for the small businesses? And we as a dentist, we fall into the small businesses. Uh, so you talked to us about what was introduced in 2017. And then in the new one, there's any changes of what they passed in 2017 versus the new one?
For the most part, they were just extensions of what was in the law. You know, most of these provisions, like if there are like bracketed amounts or income thresholds, they generally go up every year for inflation.
Mhm.
So, but those are all scheduled. There were some new enhancements as part of this new bill. Certain, you know, because on the campaign trail, there was promises made to exclude a certain amount of tips and overtime. So that was made part of this bill. And then there were some, you know, basically enhancements to what was already existing in the law
Mhm.
to help small businesses.
Okay, so since we're talking about that, I mean, the most hit the people like in cities like New York is the SALT, they called it, SALT.
Right.
And just for people to understand, before 2017, if you owned your own property and the taxes, the federal taxes, and the city and state, you can deduct it 100% from your returns. Correct, right?
Mhm.
Okay, now
Yep.
they capped it to 10,000. That was back in 2017. In the new bill that was introduced, there has been some revision for it. And it gets too convoluted. I've tried to understand it correctly, but I want to refer to a person like yourself. They moved it to 40,000.
They increased it to 40,000 for certain taxpayers.
Okay,
Right.
so who are the taxpayers that they can benefit for 40,000?
Well, there's income thresholds. There's a phase out after 600,000, and the phase out starts at 500,000 of income.
Mhm.
So between 500 and 600, you get a portion of that additional benefit.
So
But
is it
after
from
600,000,
this is after deductions and all of that, or that's before
that's just your adjusted gross income. So it's, you know,
adjusted
there
gross
are
income?
certain
Mm.
deductions that get applied to it, but it's basically your gross income minus like your contributions to retirement plans and you know, whatever gets a part of your
Reduced,
adjusted
yeah.
gross income.
Okay, so in reality, they didn't really help everybody, people like living in New York City, because I want to bring to the people, to the listeners, how is in the United States considered the rich, right? So There is fifth quintiles, the first, second, third, fourth, and fifth. And when we look at the fifth, which is the rich, in it, there's also divided between 90, 95%, 95 to, all the way to the 1%. So a rich person in the United States is somebody who makes $217,000.
Well, it depends where they live.
Yeah, exactly. But the federal doesn't look at it from where you live. They look at it as a human being. You make 217 and you are a rich person. Am I right or wrong?
Again, it's like if you're living in North Dakota somewhere, that's a
Yes,
lot of money.
I know.
In New York City,
It
probably
doesn't
be living on the
exactly.
street.
But the federal looks at it altogether the same. You
Yeah,
live in
yeah,
Iowa or you live in
exactly.
Massachusetts, New York, you all 217 for the government is you're a rich person. But in
Yeah.
reality, in New York, you cannot live off of 217. And that was during also President Obama. They made it the family combined income at $250,000 is a rich couple. And that unfortunately dragged till now. So it's very important to people that are listening and they live in New York City or big metropolis that it's ridiculous how we are considered rich in 217. One single person cannot live off it,
Right.
and pay rent and all of these things. So having said that, if you are an entrepreneur or you're a small business owner and you own your own property and you want to deduct and all of that, then you get hit with the cap, which is also reduce your deductions. Am I right on that?
Yeah, I mean, the SALT limitation, the increase to the 40,000 definitely gets cut back if your income exceeds $500,000. And then there's other provisions here in the tax law where if you exceed certain thresholds, a lot of these benefits intended for small businesses get phased out.
Mm.
So, when they say it's helping the wealthy, I mean, maybe the top bracket, the rate is maybe helping the wealthy, but most of these provisions are really designed to cut back, for the wealthy, for people earning $600,000-700,000 a year.
Basically, the middle
So
class.
it's really designed. It's geared for low income and middle class people.
Yeah. So
Yeah.
that is said. So that we have, but there is something that I've been reading about that the big cities have made what they call it pass through to kind of uh, mediate that hit from the salt. What is your take on that, and what does it mean actually?
Well, like you said, there's a basic limitation in how much you can deduct in not only state income taxes, but it includes real estate taxes too. So they limited that in the 2017 Act to $10,000 in total. So what it did, it basically penalized all the people that lived and worked in high income tax states because basically none of your income taxes that you paid were deductible, essentially.
Mhm.
So after a few years, they introduced what's called a PTET, which is a pass-through entity tax. And what that does, it sort of isolates how much of your personal income taxes are related to a business. So if you're a shareholder in an S corporation or a partner in a partnership, and that entity is generating income to you, in the past, you would pick that up, on your personal return and pay income taxes on your personal state income tax return. Well, what the PTET does is that it computes using certain, flat rates. It computes what your state and if you live in New York City, what the city tax would be based at that level of income coming from your pass-through entity, whether it's an S corp or a partnership, and it lets you pay that in the entity itself and deduct it as a business expense. And then whatever you pay through that entity is taken as a credit on your personal state return, so you don't pay it twice. So the effect of all of the PTET is that you end up fully deducting your state income tax related to your business, which saves you, if you're in the top bracket, it could save you 37% of your state income taxes. So that was one of the biggest benefits of the new law was, this PTET provision. And there were talk before they passed this law, there was something introduced in the Senate where they were trying to limit that to maybe 50% or something like that.
Right.
But luckily that was thrown out. And so the prior PTET law is now in place where you can deduct, all business related.
An interesting thing, I have to give some credits for the American Dental Association because in that article that I sent you from Wall Street, they said that also the dental lobbyists were working hard on it to keep it in place because a lot of the dentists got hammered by that because they own their own offices and they benefit from that along with other so that was, thank you for explaining it correctly and beautifully. So there's another thing that happened also recently with the loss of, or the cities, like let's take New York City, back in the day, we, from the President Bush time, and just this way people remember, understand these things, how they can change with time. As you said it before, the taxes, even if they're permanent, they're never permanent. At the time of George Bush, they passed a thing, you can buy equipment and you depreciate it at 100%. And that was going all the time good until recently, New York City stopped allowing the city, I believe, or the state, to depreciate 100% on purchase, but to do it over 4 years. Correct? Or I'm wrong with that?
Well, if it's, you're talking about real estate.
No, I'm talking about equipment.
Equipment would be under its normal lifespan, which would generally be 7 to 10 years. So I would say, 10 years is like for furniture and fixtures and things like that. Certain equipment, maybe 5 to 7 years. It depends what it is, but
there was that law that they passed, and we when we buy equipment, dental equipment, we have the right to deduct them 100% on purchase to reduce our income.
Right.
And that was working fine from the time of President Bush until recently in New York, they were not allowing anymore the 100% depreciation of equipment, correct? And you do it over 4 years. So that's something that, so you can deduct on the federal, but you cannot deduct on the city and state.
Well, you can deduct a bit over a longer lifespan.
Longer lifespan than it used to be.
Right.
Okay, so that's another benefit that we've lost locally in New York as a resident of New York.
I do want to point out one thing though, that there is another provision in the law called Section 179, and under that provision, you can also deduct 100% of what you put into service that year. There's certain restrictions. I mean, you have to be careful how you use it. It's something that you really need to sit down with your tax preparer to figure out if that works out better for you. But that would not be an adjustment on the state or city return. It's only this bonus depreciation that we were talking about just before is subject to a limitation on the state and city return.
Yeah. So you can do it on the federal, but you cannot do it on the city and state.
Yeah.
But that's only particularly in New York. I don't know about other states. Do they?
No, I would say most states that I'm familiar with have the same disallowance.
Oh,
yeah.
Funny. So brings us to another thing, since we're talking about savings for dentists, and if you own your own property, you rent yourself, you claim rent, and that rent, has a threshold. So you can, let's say, pay yourself rent for $250,000 a year. But if you exceed that, then you are moved to the commercial category, which you pay taxes on that. Is this the?
Yeah. Well, first of all, that's only applicable to businesses that you're conducting in office space within Manhattan and only south of 96th Street. So that's the only area where that tax is applicable to.
So New York City and south of 96.
Well, Manhattan itself.
Okay. The whole Manhattan, only for Manhattan.
Yeah. So the rent tax, the effective rate of the rent tax is approximately 3.9%. And it starts to kick in with after $250,000 of rent paid. So, that's how it works. There's a phase in of the tax from 250 to 300, and then the full amount of the tax is applied after 300,000 of tax.
Okay. So that's interesting, only in Manhattan. So that brings me to the question that I want to ask you. So all of us as a business owners, we would like to minimize our our tax liability, and that's why we come up with these corporates. You have the S corporate, you have the PLLC, and or LLC. But usually, as a dentist, you use the PLLC. So you are an expert in incorporations. So which one do you think is the most beneficial for somebody who wants to start and incorporate themselves?
Well, there's a lot of factors here. So you really need to sit down with your tax preparer, accountant, to see, what your situation is, because you really have a lot of things to consider. And I'll just run through the list of what those things are. First of all, I wouldn't recommend having a PLC if you're the only owner of the PLC. Because what that is it makes you, your tax is like a sole proprietor. And one of the benefits of the tax law is this PTET provision where you can deduct all your state income taxes, and you can't do that in a sole owned LLC or PLLC. So that I would not recommend at all for one owner to own a PLC or an LLC. So I would recommend having a partner, even if it has to be for a minimal 1% ownership. It's beneficial to have a partner with you, so at least you can apply the PTET provisions and deduct all your income taxes. So that's one big word of advice. The S corp, if you're the only owner, would work. The PTET is applicable to a sole owned S corp, because it's considered a pass-through entity, so that's fine. But then there's a whole host of other issues that come up with the S corp, some good and some bad, that have to be considered. One of the things with an S corp that's bad is that the city of New York does not recognize S corp status.
Correct.
So it's going to tax the entity as if it was a regular C corporation. Okay. And where that becomes detrimental is because, and I'll get into the benefit of the major benefit of an S corp, is that you can save a lot in FICA taxes. I mean, that's probably the prime reason why most people use S corp status, to conduct their business, because the way it works is that since it's a corporation, the income will flow through to you as a dividend, and you get to set your own salary. Now, the only guideline you have for that is basically they say that it has to be reasonable, right? So I've seen people set salaries of 25,000 and 50,000, 100,000, and then their business can earn 500,000 residual profits after that. So what that does for you is that the FICA tax is assessed to all of your earned income up to $176,000, right? So if you're not an S corp and you're an LLC or a self-employed business, you have to pay FICA tax on all of your income, all up to the 176, right? If you're an S corp owner, you could set a salary for yourself, say of 50,000, and then the additional 126,000 up to that 176 maximum would be considered just a dividend. So you would avoid paying FICA tax on that additional amount of income of 126,000. So that could save you $16,000 or $17,000. That's a lot. That's pretty substantial.
Mm.
The only caveat there is that there's no definition of what reasonable is. And in all the years I've been doing this, I've never seen an audit on reasonable compensation. I'm sure there have been, but I've never seen it. And for dentists or accountants, lawyers, for them to try to say that 50,000 is reasonable for what they do, that may be tough to support in an audit. So I think you have to be careful. You have to look at the business, and see whether trying to lower your salary or what you're making is reasonable and would pass muster in an audit. And in most cases, in what we do, our profession, I would say that's going to be a tough one to get by. So I don't see the benefit of the S corp election, to try to save FICA taxes in that scenario. And some of the other downsides of an S corp is, like if you have multiple owners of the S corp, you have to be really careful about how you allocate profits. It's much easier in a PLC if you have multiple owners, because you could just decide on a whim, like he should get more profit this year than me or whatever. In an S corp, it's very rigid, that every owner has to have their share of profits in exact proportion to their stock ownership. If you vary from that in any bit, it could jeopardize the S election. So it's kind of a rigid structure, it doesn't allow the flexibility of an LLC. And there's other formalities that you have to contend with, like having minutes of meetings regularly, things like that you don't have with an LLC. So S corps, they may work for some people, but I would say most people in our profession, and like being a professional, especially living in New York City, I would say it probably would not be recommended. Although you should talk to a professional about that, but I would say for the most part, I would recommend PLCs.
Yes, yeah. Well, I mean, there is the biggest thing that you said in New York, New York City, they consider them C corp, regular corporations, and they give us estimates of every quarter. So it can be very substantial actually as a payment to pay. So they assess the pass through basically. That's how they do it. So whatever you save on FICA, you're putting them on the other one, which is much higher. So since we're talking about corporation, let's assume somebody wants to buy other practice. Okay? And those practices can be a PLLC or can be a PCS corp. First of all, do you recommend them to take over those corporations, or they shouldn't be touching them?
You mean buying the stock, you're saying?
Correct, because you buy the charts basically, and then we will talk about goodwill and assets. But you buy the charts, and they had, let's say me, Edgar Alcha, DDSPC, I've been bought, have a corporation, so they bought the patients, but now the PC. Is this important for them to buy it? Does it help them? Should they ask the owner to dissolve it, or depending?
Yeah, well, from the buyer's perspective, you would want to buy the assets of the company, not the stock itself.
Mhm.
Uh, if you're operating as a PC or an S corp PC, um, you want, as a buyer, you wouldn't want to take over the stock. You'd want to buy the assets out of that business, for a number of reasons, but that's basically what your goal is. And, for the owner of the business who's selling, it's probably better to sell the stock. Um, Actually, it is better to sell the stock. So it's a competition, and the consequences are pretty substantial on either side. So usually, what I've seen is that the buyer wins out, and that the assets are usually sold. Because there could be substantial legal liability there if you buy the stock. So it makes the most sense, for a buyer to buy assets. But from the seller's perspective, they would much rather just sell the stock. It works out much better that way.
So talking about that, this is when we get into the goodwill and the assets, the physical assets. So if for the buyer, the buyer prefers to buy more assets, they
Mhm.
can deduct it. Uh, Seller wants to sell more goodwill, that they can deduct it. So uh, in dentistry, most of our equipment is depreciated, so it has zero value. The only thing that they are really purchasing is goodwill. Everybody wants to pull on one side. It's the same thing like you said before
Yeah.
on the stock and on the thing. Uh,
Right.
so, what is the? I mean, the seller is never going to say, "Hey, I want to pay you 50% assets because I pay taxes on that." And
Yeah.
the buyer will say, I'm getting goodwill, I'm going to pay taxes on it. And so, first of all, let's explain it you have to understand in dentistry, nobody understands these things. So, goodwill
Yeah.
is an income.
Yes. Well, goodwill is capital gain. Like if you're the seller and you're selling your goodwill, that's capital gain to you. Um, but in most cases, the buyer wants to allocate some of that purchase price to equipment, and furniture, fixtures, even, some leasehold improvements if there's anything that can be identified, because it gives them a much greater write-off.
Mhm.
You know, the furniture, fixtures, and equipment you can take an immediate deduction for, and leasehold improvements you can amortize over. Well, if it's under a lease, you'll probably get a quicker write-off depending on how long-term the lease is. And the goodwill, whatever's left, is amortized over 15 years. Um, But from the seller's perspective, whatever's being allocated to the furniture, fixtures, and equipment, most likely, if it's fully depreciated, will have to be picked up as ordinary income. So there's a much higher tax rate on ordinary income. And then whatever's left over would be taxed at long-term capital gains rates. So, there's a push and pull, sort of like a tug of war between the buyer and seller about how much to put towards equipment and how much towards goodwill and all that. So that's just part of the negotiations.
Okay, so that's good that I
Hmm.
need people to understand these two
Yeah.
points, the goodwill and the assets. And one more thing I want to talk about in the retirement, or if you are buying other practices and you are, as you said, PLLC 100% owner, or even S corp as a 100% owner, if you were in your own location, in your own practice, you're giving extra benefit. And now that you purchase another or you brought in other employees, those employees, it doesn't matter if they are in different location, they're going to have the same benefit as you give everybody. And that's
Yeah.
something.
Yeah, what you're talking about is like a common employer situation where you
Mm,
have like a similar business being operated under different entities, but they're commonly controlled by one person or one entity.
mhm.
And that would be considered like having a common employer. And if people have situations like that, they should consult a benefits company. There are like a pension and benefit firms that do this, for a living. They could advise on there may be ways to work around it, but in general, the concept is that if you're a common owner of several different businesses where it's the same type of business, that if you offer benefits to one entity, that you should really cover those other entities with the same
Same thing.
benefits, right? Otherwise, you may be considered to be discriminating,
Correct. And that's true. That's
from some employees. Yeah.
yeah. Uh, is there anything new in the new law about retirement, saving accounts, healthcare accounts, anything that came up or no?
Well, basically everything is pretty much the same. There's just minor modifications like for inflation, things like that. The one I don't know if it's a big thing, but it's something definitely to consider. Is something called the Trump account. I don't know if you've
Huh,
heard
I
of
never
that.
heard about that.
Okay. I mean, it's not a huge benefit, but to some of the lower to middle income people, what it is that the supposedly, if you have a child born within the next 4 years, that the government will seed an IRA type of account for that child with $1,000.
Hmm,
Now, it's supposed to go in automatically, and they say that if it doesn't go in for some reason, that there's a form you could file to apply for it. So that's the first part of that. The second part is that they let you contribute $5,000 a year into that account until your child reaches the age 17. Well, and once they turn 18, you cannot contribute any more money. So up until 17 years old. So you could put $5,000 a year, and it works like an IRA account where all the income is tax deferred until it gets taken out. And one other, it's a small thing, but it's something everybody should do if you're an employer, is that if your employee is interested in setting up this account, that you can fund the account $2,500 a year instead of paying them compensation. Put $2,500 into the account, and it's not taxable to them. So it's a way of avoiding tax on $2,500. I mean, it's a small thing, but it's something that, it's a no-brainer that everybody should do.
that's called the Trump account.
Yeah, yeah.
And that's if they have a child or if they are foreseeing a child
Well, once the child is born,
born. Yeah.
if they're born, I believe, when does it start? Let's see. Yeah, if the child is born, so starting in 25, if your child was born this year or will be born through through the end of 28, then the government is supposed to be funding $1,000 into a Trump account.
Interesting. Okay. So that's a good because I hope that
Yeah.
some of my employees or whomever is
Yeah.
listening that they have
And
$1,000 sitting somewhere.
yeah, and you could put 5,000 a year, and like I said, the
Uh,
employer can contribute half of that tax free.
mhm.
So, and
But
then the other 2,500.
uh,
Can,
you said that they can contribute tax free
yeah,
from their
but the employer.
paycheck.
Yeah,
Yeah.
yeah,
And the employer can give them $2,500 benefit if they want,
yeah,
tax free,
yeah.
and a deduction for the employer, obviously.
Right.
Mhm.
Yeah. So, I mean, it could be substantial. I mean, if you're putting in $5,000 a year for 17 years and you have the right investments in there, it could grow to a substantial amount of money.
Absolutely, that's amazing, and that's $5,000 including the 25 from the employer, or only
Yeah.
5,000 from them?
No, in total.
In
In other words,
total. So the employer can give them 2,500 and they will put
yeah,
2,500.
right.
And that is from now on, from
As
2025
far,
and forward.
yes,
Okay. Uh, we had a year of a lot of our employees have been having children, so that's a
that's
good
a
thing for
good
them
benefit.
to. Well, thank you. I didn't hear about that.
Yeah, yeah,
uh,
yeah. I'm surprised it wasn't propped up more.
yeah,
We
I
didn't
mean,
hear a lot.
should be a wow.
I know.
Yeah. Uh, it's funny. I wanted to ask you something different, but since we are talking about employees, I want to continue with that. You know, they work 32 hours is considered full time in New York, yeah. And now we talk about overtime. Um, how can they benefit with the new law that has a what you call it a tip not tip sorry overtime deduction? Uh, is this done automatically on their payroll check, or they have to file for it later on when they file their tax returns?
Well, it's probably not going to be applicable to professional practices
Ah,
because the way it's worded, it says that it has to be qualified overtime, and they define that as compensation that's overtime paid to an individual required under the Fair Labor Standards Act of 1938. So the the Labor Act has exclusions for professionals and administrative people.
ah,
So I don't believe that, for dental practices, accountants, attorneys, people that need a skill to perform their
I
work
got you.
or administrative people or those type of people are not required under federal law to be paid overtime.
Okay,
So I think for that reason, it would not be
will not
applicable.
qualify.
Yeah,
Interesting.
yeah,
So
yeah.
I have two more questions. I know I
Okay,
like to keep it 45
sure.
minutes. We have heard last year a lot about R&D. These people giving lectures. Oh, you can, as a dentist, you can uh, qualify for R&D. So what is your opinion on that? How is it valuable, or it's all just talk?
Well, the prior law required you to capitalize the whatever you spend on R&D and then amortize it over 5 years. And now you could fully deduct R&D 100%.
With the new
So
one,
that's basically what's that?
with the new one.
Yes.
Hmm.
Yeah.
So what qualify as an R&D for a dentist?
Well, it's R&D is like working on a product that is not out in the market, not being used right now. And it doesn't involve like quality control testing of existing products, things like that. It's sort of developing something new, that could be used that's never been used before. Um, so, there are restrictions, but I mean, the general concept is that, developing a new product,
Yeah.
and then the cost that you're incurring during the development of that is what was subject to capitalization in the past, but now you could fully deduct it. So you
Okay,
really don't have to worry.
so be careful out there. If you hear about R&D, you need to have a product that you have made, because that's a research and development. There's a lot of
Yeah.
bogus out there that you can claim R&D. No, you have to have created a new product. So don't be fooled by that. And lastly, a lot of either our listeners are either planning for retirement or retired or uh, and so on. That's a new thing that it's funny. I've never heard of Social Security being taxed. I thought that you paid all your life your taxes, and then all of a sudden now you're getting back your money, and then you're taxed on that.
Yeah.
So can you tell us a little bit about it?
Yeah, well, most people have to pay 85% pay tax on 85% of their Social Security benefits. There's if your income, including half of your benefits, don't exceed $32,000, then you don't pay any tax on Social Security. And then there's a short window between 32 and I think 44,000 where half of your benefits are taxed. But over that 44 or 45,000 threshold, 85% of your benefits are taxed.
And
So
with
that's
the new
most
law, it's
people.
still the same?
Yeah, yeah,
Oh, wow. So you
yeah,
work all your
yeah.
life, you pay taxes all your life, you have saved money with the government, and then the government is taking taxes again on it.
Yeah,
That's,
so because you're contributing to that fund that's paying you the money.
I mean,
And you're not
wow.
really deducting what you're paying in, but you are paying tax on what you're getting out.
No,
So
because
yeah,
that's important for people to understand that because they plan on, I'm going to get from the Social Security $2,500 a year. And then I have my retirement account that is going to give me certain amount of money. And
yeah,
I thought that this is tax free now because I'm getting this money. But now that you compile the Social Security plus your retirement plan income, that's going to be taxed also when you are retired. Am I right or wrong?
yeah, yeah, yeah. That's
Okay, excellent. So
yeah.
for your listeners, just be careful. You are taxed even when you die. Anyhow, uh, Neil, I want to really thank you for taking the time. I kept it at 45 minutes, and it was always a joy to listen to you
Sure,
and talk to you. And I learn always, so I learned quite a bit of things. And on that, thank
sure.
you so much. And
All right.
hopefully, I see you soon.
Thank you for having me. Okay.
Thank
Have a
you.
good night.
Take care.
All right.